It's good to be back. It's been too long, and my apologies for the absence from MIF. I'm going to be making a few forward-looking statements today, including Canucks in 6. I could spend most of my presentation talking about Mexico and the political noise coming out of that. I'd welcome anyone to come over afterwards. I can give a lot of color on the political noise in Mexico, not just for, if you're interested in Minera, any company in Mexico. What I will say is there are open pits being built. There will be open pits being built 10 years from now. Mining is incredibly important in Mexico. We've operated down there for 14 years, built numerous gold mines that have been very successful. Santana was one that we were ready to build right before the pandemic. We built it on budget in the middle of a pandemic, 6 months behind schedule, but on budget. And really, it had a great first year in 2022. We made a decision in 2023, and I don't want to labor on the past, but you can learn from it. We made a decision to listen to the project, not what the market wanted, and we actually cut back production last year. It was the right decision. I would do it all over again. More important to protect the balance sheet, which we did. We still sit with $20 million in working capital and $13.5 million in cash, and if we listened to the market and tried to push production levels at a time where there was a major drought happening in northern Mexico and Southern California, we could have blown that balance sheet up. The moment you spend money, can only be replaced by one of two things: making money, producing gold, or dilution of your shareholders. And we are very, very concerned about diluting our shareholders and very proud of our track record in terms of dilution. I think that comes in part by having big stakes in the company ourselves. I bought 2% of the company largely in the open market alongside of our shareholders. And when you align properly with them, it's amazing you share the same issues with stock dilution. But yeah, all advanced. Santana in production is going to grow to about 20,000 ounces a year moving forward this year, which seems modest. But when Santana's been producing, it's a sub-1,000 AISC project. The reality is we've seen everyone excited now because gold's got to $2,300 an ounce. $2,000 an ounce is a very healthy gold price. What it exposed was we have a very unhealthy gold industry. So tier one jurisdictions have a very sticky operating cost, and they certainly have high capex associated with a lot of the projects. Mexico is both good in terms of building cheaply and operating cheaply too. That gives us a free cash generation to reinvest in this growth business. Eric touched on the big boys, and the Barricks and Newmonts. They had their heyday 20 years ago. There's still organic growth you can see in intermediates. Alamos Gold is a great example, the poster child in many ways for why you invest in mining companies rather than gold. I think Newmont and Barrick are the exact opposite of that. So we don't mind building off small resources so long as there is an obvious sign where we can grow them, but we can grow out of cash flow. I love exploration. I just hate the cost of exploration. That cost normally comes at the expense of shareholders through dilution. So generating your own cash to reinvest in a business model is just smart. This was a smart business model before, the inflationary cycle and COVID and everything else. I think it's as smart today as it was back then. So low AISC, low capex. I'm a big believer in high IRRs on projects. You want that capital you've deployed to be returned quickly, low sustaining capital so that your operating cash flow is largely free cash that you're generating to reinvest and grow the business. And this is what we can arguably do on a base case basis. This is our forward run rate that we're looking for. It's somewhat permanent dependent, especially with Cerro de Oro. But on a base case perspective, we can get close to 150,000 ounces of gold production that will be sub-1,000 AISC over the coming years, building these things in sequence. And we can do that with the first project helping to support the funding of the second, and the first two projects funding the third, whilst conducting exploration and stuff, not at the expense of shareholders. Secret sources are low capital intensity. A typical gold project And this capital intensity is the annual production rate divided by the capex. Typical gold projects have capital intensity of between $1,800 and $3,000 an ounce. Our projects are at the low end of that. I used to say we have leading industry capital intensity, and I actually didn't have the data to support that. I thought it was the case. We had our bankers at National Bank come up with this table to indeed support the fact that this is leading industry. Capital is very important to us. As I said, dilution is too, because we're big stakeholders in our own companies. I have bought 9 million shares of our company in the market alongside our shareholders. I've felt their pain over the last 12 months, or last 2 years actually. But it drives you to make smart business decisions when you know that if you're going to dilute your shareholders, you're going to dilute yourself too. So we have an experienced operating team in Mexico. Our CEO, largely, you never see him. That's because he's where you want him to be. It's maybe not where he wants to be, but he spent most of the last 4 years doing the hard yards in Mexico, whereas I get to be in Canada and just having problems with PowerPoint presentations. So a roughly 150 million market cap. We made tough decisions last year. They were the right decisions. I'd do them again to protect the balance sheet. The moment you spend money, you got to replace it. So we went through last year where we curtailed some gold production at Santana. That's going to increase again this year. And it allowed us to maintain roughly $20 million in working capital. And we ended last year with about $13.5 million in cash. For our existing portfolio of assets, we have all the money that we need. We are always looking for opportunities, and there are plenty of opportunities out there, especially for a company like ours that can take someone's asset and actually build it into a mine. We have an industry that, unfortunately, we don't have enough people that want to build. Building comes with its own trials and tribulations, but to me, it's a lot less risky than crossing your fingers on a drill hole hit. Although, judging by my peers on the stage today, they've got plenty of juice with exploration drills to go after. So the first mine in northern Sonora, if this is only ever a 20,000 ounce a year mine for 5 or 6 years, it will spit out its cash flow and its capex in free cash every year. So it's a fantastic ATM for us, and it basically allowed us to put together a debt package to build our second mine. It's a modest starting resource, 300,000 odd ounces at a much better grade than you'd see in the Great Basin of Nevada, coupled with Mexican cost. You know, this is a sub-1,000 AISC project, so very high margin. I always say margin's more important than whether a project's high grade or low grade. We should be focused on making money. And we have way too many operations in this industry that apparently don't want to focus on actually making money. And Eric alluded to that earlier. The game changer is Cerro de Oro. This is a step change in our production. We picked it up in 2020. We spent a little longer, about a year longer, on the surface rights we wanted, because we're not just permitting the base case that I'm about to show you. We're actually permitting an upside case, which is more like 90,000 ounces a year for 11 to 12 years. But this is the base case PEA. It's 8 years, 60,000 ounces. It's a 28 million capex. We've got a $25 million funding package lined up for it, so there'll be no nasty surprises for shareholders when permits come, and we believe this will get its permits. It's in northern Zacatecas, which is probably, if you were playing mining family feud in where to best build a mine in Mexico right now, the top answer on the board would be northern Zacatecas. So we didn't want any nasty surprises on how we were going to fund this upon receipt of permits. So we get the permits, it's getting built. It's about a 6-month construction time. This is a sub-1,000 AISC project, but we're also permitting something which is more like 90,000 ounces a year for 11 to 12 years. Low grade, incredibly low strip. This is right at surface. I think the life of mine strip is 0.3 to 1. Year one is 0.1 to 1. For every 10 tons coming out of the pit, only 1 ton actually goes to waste. So I think year one AISC on this project is something like, it's sub $700 an ounce. So huge margin. which is great for us. It will pay back its capital in a year or less than a year, and that was at $1,600 gold. We run all of our projects at conservative gold prices because we have a cyclical industry. For us, it's really important to show projects that will make money in any gold environment out there. So La Fortuna, we ran a PEA in 2018. It was a $1,300 gold environment. We ran it at $1,250. It still had close to 100% IRR. Yes, 6 years on, the capex will be up a little, but not by much. We already own the 2,000 ton a day mill. So maybe this is a $35 million capex project now. Its life of mine AISC was $500 or sub $500 an ounce. It's a 3.5 to 4 gram open pit. It's hard to mess one of those up, about a 6-to-1 strip ratio. If it's got one issue, it's got a 5-year starter pit. So the reason this one, which is sitting with its permits in place, is going to get built second, is it's the perfect repository for us putting some of the cash flow from Cerro de Oro into growing this, so that when we're building it with appropriate mine life and probably fully utilizing that mill. It's a great third-string quarterback sitting on our bench with permits in hand saying, put me in, coach. But right now we know Cerro de Oro should sequence next. Eric mentioned copper. We have some hidden copper assets in the company, and we're looking to expand on those. We're going to do this at the subsidiary level. It won't deflect from our gold business. The goal is to basically spin out a separate low capital intensity copper producer in due course. The big thing is SX-EW copper production is kind of the sister to open pit heap leach. The difference is reagent use. Instead of gold and cyanide, for copper, it's sulfuric acid. But they're incredibly low capital intensity projects. And it made me coin this slide where I said copper capex doesn't have to start with a B. We think copper, we think giant open pits, and we certainly think giant capex requirements. We can build copper mines in that 30 to 40 million capex number. And build a fledgling Minera copper company that we will look to spin out for our shareholders at some point. They will either own through an indirect holding with Minera keeping all those shares, or in time probably spinning out a good portion of those. I think the goal for this is 2025. We're going to continue to put some meat on the bone at the sub level this year. And we've already had a lot of interest on funding this and funding a new low-cost copper producer, again in northern Mexico. 2024 catalysts. We are expanding operations at Santana this year. We're waiting on a permit amendment there that will allow us to show that expansion has longevity over the next 5-6 years. Cerro de Oro, big thing to watch out for, the permitting news. But don't think there'll be some overhang upon that permitting news, because we got the funding to build it. And then the analysts that follow our stock are going to be able to start looking and going, okay, let's look what the multiple on 80, 90,000 ounces a year of low-cost production would look like. So we'll be immediately upon receipt of permits be looking at that construction decision. We've already expanded Minera Copper with a deal announced, and we're still looking at gold opportunities. We've got a strong balance sheet. We've got a lot of market support. But this year is about showing those shareholders that stuck with us through a tough 2023. Their patience with us was well placed, and we're looking forward to a much more positive 2024 and beyond. Thank you very much.